Imagine an agreement that enforces itself. No lawyers, no banks, no waiting, and absolutely no chance of one side cheating. That's not science fiction. That's a smart contract, and it's already moving trillions of dollars across the internet. Today, we're pulling back the curtain on the most powerful invention in crypto after Bitcoin itself. So what exactly is a smart contract? In plain English, it's a program stored on a blockchain that automatically executes when certain conditions are met. Think of it like a vending machine. You put in money, you select a snack, and the machine automatically gives you what you paid for. There's no cashier, no negotiation, and no way to trick it. The rules are built right in. A smart contract works the same way, but with digital money and data instead of candy bars. If X happens, then Y automatically follows, guaranteed by code, not by trust. Smart contracts were created to remove middlemen from agreements. Instead of relying on a bank, lawyer, or company to enforce a deal, the blockchain does it for you, transparently and permanently. In 2026, this matters enormously because entire financial systems, digital ownership, and online services now run on this technology. Understanding smart contracts is like understanding how apps change smartphones. It's the foundation everything else is built on. Once you grasp this idea, the rest of crypto starts making sense. The idea of smart contracts is older than most people think. Back in 1994, a computer scientist and legal scholar named Nick Szabo first coined the term. He imagined digital agreements that could enforce themselves automatically, using his famous vending machine analogy. But there was a problem. The technology to make it safe and trustless simply didn't exist yet. That changed in 2009 with Bitcoin, which proved a decentralized ledger could work. However, Bitcoin's scripting language was intentionally limited. The real breakthrough came in 2015 when a young programmer named Vitalik Buterin launched Ethereum. Ethereum was purpose-built to run smart contracts, offering a flexible programming language called Solidity that let developers build almost anything. This unleashed an explosion of innovation. The 2017 ICO boom, the 2020 DeFi summer, and the NFT wave all rode on smart contracts. Over the years, they've become faster, cheaper, and more secure, especially after Ethereum's major upgrades. Today, dozens of blockchains support smart contracts, and they underpin a multi-hundred-billion-dollar ecosystem that keeps evolving every single year. Let's peek under the hood without getting lost in jargon. A smart contract is basically code written by a developer that lives on a blockchain. Once deployed, it can't be changed or deleted, which makes it extremely reliable. Here's how it works, step by step. First, a developer writes the rules. For example, if Alice sends 1 ETH, then transfer this digital ticket to her. Second, that code is uploaded to the blockchain, where thousands of computers store an identical copy. Third, when someone interacts with the contract by sending a transaction, every one of those computers runs the code and checks the result. If they all agree, the action executes automatically and is recorded forever. Think of it like a group of thousands of referees all watching the same game. No single one can cheat because the others would catch it. This is why smart contracts don't need a trusted middleman. The network itself enforces the rules. The trade-off is that running code across so many computers costs a small fee, often called gas. So why are people so excited about smart contracts? Let's break down what makes them special. First, they're automatic. Once conditions are met, the contract executes instantly without you needing to chase anyone down. Second, they're transparent. The code is publicly visible, so anyone can verify exactly how it behaves before trusting it with their money. Third, they're trustless. A slightly confusing word that actually means you don't have to trust a person or company because the code does what it says. Fourth, they're tamper-proof. Once deployed, no one can secretly change the rules in their favor. Compare this to traditional systems. A bank transfer might take days, involve fees, and depend on business hours. A smart contract settles in seconds, 24 hours a day, anywhere on Earth. For everyday users, this means cheaper services, faster transactions, and access to financial tools that once required permission from gatekeepers. Whether it's earning interest, trading assets, or proving you own something digital, smart contracts hand control back to individuals. That combination of speed, transparency, and independence is genuinely revolutionary. Smart contracts aren't just theory, they're powering real applications right now. The biggest is decentralized finance, or DeFi. Platforms like Uniswap let you swap tokens instantly without a bank, while Aave and Compound let you lend and borrow crypto, all run entirely by smart contracts holding billions of dollars. Then there are NFTs. When you buy digital art or a collectible, a smart contract records your ownership and can even pay the original creator a royalty every time it's resold. Gaming is another huge area, where players truly own in-game items thanks to contract-based ownership. Beyond crypto-native uses, real companies are experimenting too. Supply chain projects use smart contracts to automatically release payments when goods are delivered. Insurance platforms like Ethereum pay out flight delay claims automatically the moment a delay is confirmed, no paperwork required. Even some governments are testing blockchain-based land registries. The common thread is removing friction and delay. Anywhere a rule needs enforcing without human bias or slow bureaucracy, a smart contract can step in. And this is still early. The use cases keep multiplying every year. Now let's be honest, because smart contracts aren't perfect. The biggest risk is bugs in the code. Because contracts are immutable, if a developer makes a mistake, hackers can exploit it, and the money is often gone forever. Billions of dollars have been lost this way in incidents like the DAO hack and countless DeFi exploits. Always check whether a project has been professionally audited. Second, there's the code is law problem. If a contract does something unexpected but technically correct, there's usually no customer support to reverse it. You're responsible. Third, regulatory uncertainty is real. Governments worldwide are still deciding how to treat smart contracts, and rules could change quickly. Fourth, scams are everywhere. Malicious contracts can drain your wallet the moment you approve them. Common beginner mistakes include clicking unknown links, approving suspicious transactions, and investing in unaudited projects promising huge returns. The golden rules are simple. Only interact with reputable, audited platforms. Never invest more than you can afford to lose. And always read what a transaction is actually asking before you sign it. Ready to explore smart contracts safely? Here's a practical roadmap. Step 1. Get a self-custody wallet like MetaMask or Rabby. These browser wallets let you interact directly with smart contracts while you keep control of your keys. Step 2. Start on a well-established blockchain. Ethereum is the most battle-tested, while networks like Base, Arbitrum, and Polygon offer much lower fees for beginners. Step 3. Fund your wallet with a small amount. Think $10 or $20, purely to learn. Never start with your life savings. Step 4. Try a simple, reputable application first, like swapping a tiny amount of tokens on Uniswap. Watch how the transaction and gas fee work. For research, use trusted sources. Read a project's documentation, check if it's audited on sites like Certic or DeFi, and see how long it's been running. Follow educational channels and communities before trusting anyone with money. The key mindset is patience. Treat your first weeks as a learning phase, not a get-rich scheme. Once you understand how transactions and approvals work, everything becomes far less intimidating and much more empowering. So where is all this heading? The future of smart contracts looks incredibly promising. One major trend is scalability. Layer 2 networks and new blockchain designs are making contracts faster and dramatically cheaper, meaning everyday people won't pay high fees just to interact. Another is account abstraction, which lets wallets recover lost keys and even sponsor gas fees, making crypto feel as smooth as a normal app. We're also seeing smart contracts connect to the real world through improved oracles, feeding them live data like prices, weather, and shipping status, unlocking countless new applications. Experts predict tokenization of real-world assets will explode, with everything from real estate to government bonds represented and traded via smart contracts. Major financial institutions are already piloting this. Of course, challenges remain. Regulation must catch up, security must keep improving, and user experience still needs work. But the direction is clear. In 5 years, you may use smart contracts daily without even realizing it, the same way you use the internet's underlying protocols today. This technology is quietly becoming the invisible plumbing of the digital economy. So, what crypto topic should we break down next? DeFi, staking, or how wallets really work? Drop your questions in the comments below and I'll answer as many as I can. If this video made smart contracts click for you, hit subscribe and the bell for weekly crypto education from Aurelian Wealth. Until next time, stay curious and stay safe out there.